Hello everyone. I will continue with the remaining part of chapter 7 in this lecture. So far we have looked at the basic concept of security analysis and also looked into the details of economic analysis and industry analysis. Now we look at the last level of analysis, that is fundamental analysis. So in this case, we look at companies' financial statements and try to find relevant information to determine the intrinsic value. So what does company analysis do? We look at historical data in the accounting statements and we try to find the company's competitive position, the quality of assets owned by the company, sales, profitability, its capital structure, that is the sources of financing and so on. So this helps us to determine the intrinsic value of the stock. So what are the financial statements that we use? The first one is balance sheet. Balance sheet has assets, which are items that the company owns, and liabilities, which are the items that the company owes. That means the company has an obligation to pay off in future. And stockholders' equity is the difference between assets and liabilities. And this is the claim held by the firm's shareholders. And assets equal to the sum of liabilities. And so this is a typical balance sheet. So we have current assets, that is items which are owned for less than a year, so cash, receivables, inventories, and so on. And then we have non-current assets, mainly property, plant, and equipment, less of accumulated depreciation. So that is the net non-current assets. And on the liability side, we have current liabilities, obligations which are due within 1 year, accounts payable, short-term debt, and so on. Then we have the non-current liabilities, which are obligations which are due after more than 1 year, or which are due over the period more than 1 year. Long-term debt is an important part. And assets, total asset minus total liability is the stockholders' equity. So we have common shares and retained earnings. Retained earnings is a part of the company's profits year after year, which is accumulating in the company's own account. Then we look at income statement. So it provides a financial summary of the company's performance, the company's operations rather, during a certain period of time. So it has got revenues, that is sales, different categories of expenses, and what is the profit or loss earned by the company. So income statement shows how efficient is the company in using the assets listed in the balance sheet and generate profits. The first item is sales, and then we have cost of goods sold, the other expenses such as sales, general and administrative expense, depreciation. Then we have the total operating expenses. That gives us the earnings before interest and taxes. Interest is due on the debt assumed by the company, and taxes is due to the government. So that gives us the net profit after tax, from which we can calculate earnings per share. It's profit assigned to each share as well as dividends paid out to each share. The next financial statement is the statement of cash flows. So this gives us a summary of the company's cash position. So what is cash outflow from the company? What is cash inflow into the company? So that helps us to understand how good is the company's financial position in reality, in terms of cash generated or cash spent. So one category is cash flow from operating activities. So we have the net earnings, and we add back non-cash expenses like depreciation. Then we reduce it by the decrease in current assets. And we and we increase it by the increase in current liabilities. So increase in current liabilities means the company is not paying off liabilities. So there is no net cash outflow, and hence it improves the cash position of the company. So that is why we are adding back any positive change in current liabilities. Next, we look at the cash flow from investing activities. So in this case, the company is acquiring long-term assets, non-current assets, and the company has experienced cash outflow in order to acquire property, plant, and other assets. So that gives us the net cash flow from investing activities. And then we have net cash flow from financing activity, maybe cash outflow due to payment of dividends, cash outflow due to repurchase of stock, buyback of stock. So using these three category of information, cash flow from operating, investing, and financing activities, we get the net change in cash position. And that helps us to understand whether the business is actually generating cash or not. Now we look at ratio analysis. So ratio analysis means we take different accounting items from one or more of the financial statements, and we use them to evaluate the condition of the company. Then we can compare the financial ratios with the company's historical data, or we can also compare the ratios with those of competitors. So that helps us to understand how is the company placed with respect to competitors, or how is the company performing with respect to itself. There are 5 groups of financial ratios. We'll look at each of them one by one. So the first one is liquidity. Liquidity means the company's ability to pay off short-term obligations using its short-term assets. So current assets by current liabilities. That gives us an idea of the company's liquidity. It's called current ratio. It should always be more than 1 because the assets available to pay off liabilities should be more than the liability itself. Another ratio is the quick ratio. So in this case, we subtract inventory from the current assets because inventory is the least liquid and it is difficult to dispose and acquire cash. So we only look at current assets excluding inventory and try to determine whether it is sufficient to pay off all current liabilities. Again, this ratio should also be more than 1. So now that we know the current assets and current liabilities, the difference between them is the net working capital. So the idea is current assets can be converted into cash, whereas current liability means the cash will go out. So the money which is locked up in current asset is not readily available to pay off liability. So what is the difference between current asset and liability? That is the working capital, or maybe that is the additional funds that the company needs to keep at hand. How much liquidity is enough? Investors don't want companies to lock up their funds in too much of liquid assets, too much of current assets. So the current assets should be enough to cover current liability, so that there isn't a significant requirement of net working capital. Then we look at activity ratios. So this means how efficient is the company in converting assets into sales. So account receivable turnover means sales by accounts receivable. So this ratio gives us an idea how quickly or how efficiently is the company converting receivables into sales. Higher ratio means that from a small amount of receivables, the company is generating more sales. Similarly, inventory turnover, sales by inventory. How efficiently is the company converting inventory into sales? Total asset turnover, how efficiently the company is converting total assets into sales. The higher the ratio means less asset, less inventory, or less receivables are required to generate the same amount of sales. Then we look at leverage ratio. So this indicates the amount of debt that the company has assumed. Because debt needs to be paid off, there is also a regular interest payments. This is a financial burden for the company. Hence, it is important to look at the debt levels of the company and also compare it with other accounting items. The first is debt equity ratio, the relative amount of funds available from debt and equity, that is from lenders and shareholders. Ideally, this ratio should be low, which means that the company has less debt with respect to equity. So it has less financial obligations for payout. Equity multiplier is again an indirect way to look at the debt levels. It is total assets by equity. If the ratio is higher, it means that the company has assumed more debt for the same level of equity. So the higher value of equity multiplier means the company has assumed more debt. So it can be a cause of concern. Times interest earned. This is also called coverage ratio. So we look at earnings before interest and tax, and then we look at the interest expense. So whatever is the company's performance or whatever is the company's cash position before paying out interest, is it sufficient to cover interest? So as a rule, it should be 8 to 9 or a higher value. But if the ratio falls to 2 or 3 or lower, then this is a cause of concern that the company is not doing business in a way that it can cover its debt obligations. The next category of financial ratios are the profitability ratio. This looks at how good is the company in generating profits. How good is it in running the business? So higher value means, or higher ratio means the company is more profitable. Net profit margin is net profit by sales. Return on assets is net profit by total assets, which means how efficient is the company in using assets to generate profits. Similarly, return on equity is net profit by shareholders' equity. How efficient is the company in generating profits for its shareholders? So we can also break down return on assets and return on equity to understand what are the contributing factors to these profit ratios. So return on asset is the product of net profit margin and total asset turnover. Now that we have broken down return on asset into two separate ratios, so we can figure out what is contributing more to higher profitability. Is it the company doing better business, or is it the company running very efficient operations and converting its assets into higher amount of sales? So this is an important metric, or this is an important insight which is available by breaking down return of asset into different subcomponents. Similarly, return on equity is expressed as the product of return on assets and equity multiplier. So now we have three subcomponents of return on equity: net profit margin and total asset turnover from return on assets, and equity multiplier is the third component. So now we can figure out what is contributing more to the profit margins for, or what is contributing more to returns generated for shareholders. Is it the company doing better business? Is it the company running its operations efficiently? Or is it that the company has assumed more debt, which is magnifying the profits? Because in a previous chapter, we noticed how financial leverage tends to magnify both the profit as well as the loss. So we can find out which factor is contributing more to the profitability. Then we look at common stock ratios. So this helps us to understand what is the allocation of different accounting items to each share of stock. So first is earnings per share. That is the profits generated and distributed among total outstanding shares. That gives us the earnings per share. Similarly, dividend yield is the dividend payout divided by total outstanding shares. So what is the dividend allocated to each share? Other stock ratios, price to earnings ratio, which is called the PE ratio. So here we take the net profit, subtract the preferred dividends and divide it by the common shares outstanding. So that gives us the earnings per share. Then we divide the share price by the earnings per share. So that gives us the P by E ratio. So if a company has a very high P by E ratio, which means its price has increased substantially and it may have become overvalued as compared to the profits it is generating. So there is a chance the share price may decline. So P by E ratio is one way to understand how the share price may perform in future. Then we have the price earnings growth ratio. So we have the P ratio divided by the 3 to 5 year earnings growth rate. If the ratio is more than 1, then the stock is fully valued. So the stock price may decline in future if the ratio is very high, which means it's an overvalued stock. If the ratio is 1, means the stock price is in line with earnings growth. As earnings are increasing, the stock price is also increasing. And the ratio less than 1 means the stock is undervalued. The stock is expected to rise more because the way the earnings growth are increasing, the stock price is not increasing at the same rate. It is increasing at a slower rate. So these are some key predictions that we can do based on the common stock ratios. Then we have looked at dividend per share. This is the total dividends divided by common shares outstanding. So that gives us the dividend per share. Then we have the dividend payout ratio, that is the fraction of earnings which is paid out as dividends. So it is dividends per share by earnings per share. So here we must notice one thing, that a rising dividend payout ratio can be a cause of concern. It could be that the dividend payout is constant, but the earnings per share is going down. So what happens is the company may not be able to cut back on dividend payout because investors may not take it in a positive way. So they tend to maintain the dividend payout. But the company's operations or the company's business may not be going well, because of which earnings is going down. So that is why dividend payout ratio is increasing. So sometimes an increasing dividend payout ratio is a red flag that the company's earnings are not going well. Book value per share, we have looked at this concept before. So we find the difference between assets and liability, which gives us the stockholders' equity. And then we divide it by the outstanding shares. So that gives us the book value per share. So most companies have a market price which is higher than the book value. If the market price is less than the book value, then this is a cause for concern that the company is not doing well. So now we come to price to book value ratio. So we have the market price by the book value. In most cases, it will be more than 1 because market price is higher than the book value. However, if it is too high, then it could also mean that the stock price is overvalued and it may decline in future. So this is another takeaway from the common stock ratio. It helps us to understand how the share price will perform in future. So what do we do with all this information available from fundamental analysis? So One option is that an individual computes all these numbers themselves because the company has to disclose all financial information. It is publicly available, and investors can use publicly available information to do a fundamental analysis. The other option is to get the information ready-made from brokerage houses and other financial firms. So they will publish reports with the key financial ratios. Now, after that information is available either through self-calculation or from reference sources, the fundamental analysis requires that we compare the company's financial ratios with the historical data to understand how is the company performing with respect to itself. We can also compare the company's financial ratios with the industry average or with specific competitors. That helps us to understand where does the company stand with respect to competitors. That will help us figure out whether the company is attractive in terms of investment and take a final decision whether to buy or sell the stocks of that company. So this is an example of one company, and we look at its financial ratios across different years. So we are doing a historical comparison. Then we consider multiple companies and we look at their financial information as well as the financial ratios. So in this case, we are doing a peer comparison. So this kind of analysis helps us to understand the attractiveness of the company's stock. So that's all for chapter 7. I will end here. Thank you.